The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody, and welcome to our Risk Mitigation Plan Design webinar. It is 10 o'clock, and we're going to start right on the nose, and we're certainly going to end before 11 o'clock. But we like to take this opportunity to say thank you very much for attending. Close to 75 people on the call today, so we're pretty excited about that, and we're here to talk about risk mitigation. Oops, that's weird. I don't know why that happened. There we go. So welcome to the Benefits Trust. Hold on a second, that jumped ahead there. Welcome to the Benefits Trust. We are a full-service third-party benefit administration company. We were established on January 1st, 1994, so we're 24 years old, and we're excited about the opportunities that exist in 2018 and beyond. It's an exciting time to sell benefits. It continues to be a very exciting time to sell benefits. A little bit of housekeeping. As I mentioned, we are a full-service third-party benefit administration company established on January 1st, 1994. We work with brokers like you do. We do not sell direct, so we work directly with brokers like yourselves. So when we're talking today about benefits and so on, we're talking really about how we work with folks like yourselves and how we help you serve your end user clients. So at the end of the presentation today, we're going to be spending an hour together or just under an hour together. You're going to get a CE credit for participating today. You're going to get a very short survey. And with that survey, it's only about 4 or 5 or 6 questions long. But we want to get feedback from you on a couple of things. Number one, how we can do things better. But in addition to that, we want to get a survey or survey results on future topics that you want to see covered. And today's session, which we titled Risk Mitigation through Plan Design, is exactly based on feedback that we've received from you last year in 2017 during our webinar series. So today's purpose, although we're going to be talking about risk mitigation, today's purpose is really to spend an hour together to give you guys a CE or give you folks a CE credit, but really it's to help you grow. We want to help you grow. We want to help you grow your business either through securing your existing clients with a stronger, more profitable relationship, or helping you gain additional relationships and helping you increase your profit. So really, we want to help you grow. And if we're going to spend the next hour together, we want you to be able to get an idea or two from us that you can use to help you and your business grow. And I think that would be successful. My name is Robert Crowder. I'm going to be the presenter today. I'm the president and founder of the Benefits Trust. I'm the guy here on the left. Mike Ignatz is our moderator today. He's going to be chiming in from time to time. He's the guy here on the right of the page.
Good morning, everybody.
So there's Mike. As well as that, if you have any questions, just feel free to type them into your the question box on your screen, and we'd be happy to either answer them throughout the remainder of the presentation, or if not, we'll certainly answer them offline. We encourage you as well after the presentation to visit thebenefitstrust.com. A lot of valuable information in there and video. Go to the Advisor Resource Center. And in addition to that, we're going to be signing you up, if you're not already signed up, for our monthly newsletter called The Trusted Advisor. So lots going on here today, and we're going to have a ton of fun, but let's jump right into it. The agenda on the things that we want to cover today is really about risk mitigation. That's what we want to talk about. It's about risk mitigation, and we want to talk specifically about drug plans in your client's benefit plans. We want to talk about combined and family maximums. We want to talk about life insurance and accidental death and dismemberment insurance. So we want to cover those 3 items. We're going to dig deeper into each of those, and we want to keep that risk mitigation spin when we're talking about these 3 distinct areas. So before we get started, let's just put things into context. The majority of people that are on the call today, although we do invite people from across the country, but the majority of people that are on the call today are really from Southern and Central Ontario. And it's interesting when you look at this map. I know I don't have a problem with driving up to Barrie, or I don't have a problem driving out to Peterborough. I know I certainly don't have a problem going to Waterloo or Niagara. And when I look in that area, that's sort of the market in which we are working in here at the Benefits Trust the majority of the time. Yes, we do have clients in the far north. Yes, we do have clients across the country. But really, that's sort of the area. And that's where there's about 50,000 businesses. So when we look at, more than 50,000 businesses, when we look in this area, the marketplace is absolutely huge, but we need to put things into context. We need to put things into context because the marketplace is so big. And when we look at different size groups, you're looking at 1 to 100 employees, you're looking at 100 to 1,000 employees, 1,000 to 10,000 and 10,000 plus. Our focus and our comments today are basically on that smaller end of the marketplace, although these aren't distinct areas or distinct differences in areas, and we certainly work with larger clients. It's just really we want to focus our comments today on the smaller end of the marketplace, where the marketplace is absolutely enormous, and it's actually unlimited when you think about it. There's 50,000 businesses or 70,000 businesses in this area with 1 to 100 employees. Well, there's 75 people on the call today, and that's 1,000 cases for each person. So there's lots of room. So the marketplace is absolutely endless. So what is a benefit plan? We're here to talk about benefits, and we're here to talk about risk mitigation. But what is a benefit plan? And having been the president of the Benefits Trust for the last 24 years, and having worked in the insurance as a licensed insurance agent for the last 30 years. It'll be my 30th anniversary in August of being a licensed insurance broker. I've been working in this benefits field for some time, and one of the biggest ahas I've had over the last number of years is talking to clients and talking to end user clients and saying, what is a benefit plan? And all of a sudden, the light bulb goes off in their head when you say the benefit plan is a promise between an employer and an employee or a group of employees. And you, as the owner of the business or the manager of the business or the president of the business, can decide what it is that you want to promise and when you want to promise those employees and what you want to promise those employees. So it creates this, when you use language like it's a benefit plan is nothing more than a promise, all of a sudden that light bulb goes off and you can see the change in the employer's mindset on what it is that they want to do going forward. And it's really all about future-based conversations. So when we use the word promise, hey, the question is, terrific, what is it that you want to promise? And as I like to say, I like to break things down into very simple terms. Well, there's two types of promises that a business owner can make to an employee or a group of employees. And often those promises are either high-cost, low-frequency promises. So again, hey, you're making someone a promise. It's going to be a high-cost, low-frequency promise. What's that? Well, if you die, Mr. Employee, I promise I will pay your named beneficiary $50,000. That's a high-cost promise that I'm making, but it happens very infrequently. So as I like to say, high-cost, low-frequency promise. This is the reason why I'm saying this is just to sort of set the stage on where we're going with risk mitigation, but it's also to give you some language, if you haven't heard this already, to also talk to clients about, because it gets their heads nodding up and down. So there's two types of promises. One is a high-cost, low-frequency promise. So if you die, I promise to pay the beneficiary $50,000. That's a high-cost, low-frequency promise. Then the opposite occurs as part of an employee benefit program. Oh, I don't know if anybody can hear that, but there's a car alarm going off in the parking lot right beside my office, so I apologize for that background noise. The opposite occurs as well. Two types of promises, high cost, low frequency, and low cost, high frequency. And quite simply, the chance of, it's a low cost, it's just usually a few $100s or less, but the chance of it happening are pretty significant. When you go to the dentist, Mr. Client, or Mr. Employee, pardon me, I promise to pay 80% of the cost of that up to a certain maximum. That's a low cost, high frequency promise. How many of us are going to die in the next 12 months? Well, hopefully none of us. How many of us are going to go to the dentist in the next 12 months? Well, I'm going on Tuesday after Family Day. All right. So yeah, we're all probably going to go to the dentist in the next 12 months. So again, the difference, high cost, low frequency, low cost, high frequency, and that just, gets a client's mindset in the right spot. And when we look at benefit plans, we can look at benefit plans in sort of three different areas. There's a defined benefit plan, or a traditional type of benefit plan. There's a defined contribution or healthcare spending account type of benefit plan, or there's a hybrid plan, which is a combination of the two of those. And yes, we're using sort of different language, but again, it's about the client's mindset. The defined benefit, you define the benefits that are in the promise. The cost is unknown. The cost changes on an annual basis. So it's just like a defined benefit pension plan. The benefit is promised. The cost changes on an ongoing basis. So these are what most traditional plans look like. They're a defined benefit plan. It's going to be 80% of this to a maximum of $1,500, or it's going to be, $50,000 of the life insurance, but the benefits are completely defined. Defined contribution plan, more of a healthcare spending account. All it is saying, hey, great, the amount of money that's going into a benefit plan is going to be defined, but what you claim on is not defined as long as it's an eligible CRA expense. Quite simply, that's the other end of the spectrum, or a healthcare spending account. But what's becoming very, very popular is a combination, a hybrid type of plan. So it's got defined benefit elements to it, but it also has defined contribution elements associated with that employee benefit program. Great. So now let's get into, we set the stage. We're talking about smaller businesses. We're talking about both defined benefit, defined contribution, and risk mitigate, or defined benefit, defined contribution, and hybrid type of plans. And again, these are for your clients. So let's get into some risk mitigation using plan design ideas. The majority of benefit programs out there are traditional type of plan designs, smaller employers, right? And what is it that we can really do? When we're talking about risk mitigation, and we're talking about a 10-person group or an 8-person group or a 7-person group or a 30-person group, what is it that we can really do that's meaningful with respect to risk mitigation? What's going to be of value to that end user client? So that's what we want to talk about today. And I think the great place to start is, instead of saying, hey, here's a whole bunch of great solutions, but it's about really start by asking great questions, right? You can ask, as somebody said to me some time ago, solutions are abundant. Great questions are rare. So let's start by asking some great questions to the client. And as I like to say, and you've heard me, if you've participated in these webinars in the past, you've heard me say future-based questions. You want to find out where the client is going, not where the client has been. Where the client is going is most important. Here at the Benefits Trust, that's why I was saying we're excited about 2018, and we're excited about the years beyond that, because we're just excited about the future. We're planning on growing. We continue to grow. We continue to be active in our business. We've got very aggressive growth plans. We're hiring people. So it's if someone was coming in and asking us these great questions, we'd be talking about the future with enthusiasm. So let's start about asking prospects and your clients great questions. I sort of cut off there. Pardon me. This is the first time we've done this presentation. So when we see it up here live, it's a little bit different. Don't worry about it, Mike. There we go. But the first question is, what are our first great question? Hey, Mr. Prospect, Mrs. Prospect, tell me about the groups within your group. What are the groups within your group? And people look at you like you got two heads. And, for example, here at the Benefits Trust, there's an ownership group, there's a management group, there's an administrator group, and there's a casual part-time group. So there's 4 different groups within our group. And you get the employer talking about that regardless of the type of business they're in, or regardless of the number of employees that they may have. There are different groups within the group. So you get them talking about that, and you say, what is the purpose of your benefit plan for each of those groups, and what do you want to promise those particular people? As an employer, how would you feel if something happened to each of those different groups, and how would you feel if it to get their idea? And quite frankly, employers are business owners and employers are very forthright with their answers. They say, hey, I don't really care about this particular group as much as I care about the management group, or as much as I care about the ownership group. These people are replaceable. They don't care about me. I certainly don't care about them, right? And so it's very interesting, the answers you get back when you ask these very pointed questions. And what's your future budget for these particular groups within the group? What's your employee turnover like for these groups within the group? What's your compensation philosophy for these groups within these groups? And it's really interesting, because when you're talking to employers like this, you're not necessarily talking about benefits. You're talking about their future and where they're going and how they want to deal with each of these groups within the group. And it's just a great way to start a very powerful conversation with your existing clients or new prospects about the future. So when we're talking about the future, you got to understand where your client is going. And then I think it's important to help them with risk mitigation, so you can steer that conversation and lead that conversation when we're talking about the future, they're open for business, and you can talk about building a benefit plan that works for them, keeping in mind risk mitigation, and you can build a different benefit plan based on the different compensation philosophies and the different risk tolerance levels and so on they have within each of those groups within a group. So, in talking about risk mitigation, where's the biggest risk in a benefit plan? Where's the biggest risk? Well, the biggest risk that we are seeing out there for sure is drugs. So we're talking about risk mitigation, with the different groups within the groups. Hey, what are we talking about? The biggest area of risk is in drugs. And this is something that's relatively new over the past 30 years or 50 years. But this is something that's relatively new. Many of us may not have been practicing for 30 years, but I never understood why they call it practicing, Mike. Why do they call it practicing? I've been doing this for 30 years. I haven't been practicing, hopefully. I've made some expensive mistakes along the way, but, practicing is not, it's every day is game day. Anyways, enough of that. The biggest risk is drugs. Today, you can buy drugs that are $75,000 a year or $150,000 a year or $500,000 a year, and they're covered by your drug plan. That's the biggest risk. And we look at a case. A 20-employee case, there's $3,000 per employee of annual cost of a fairly comprehensive benefit plan. $60,000 in annual premium, $5,000 a month. That's a nice case. I don't care what anybody says. That's a nice case. We call those singles. We hit singles out of the, we hit singles all day long. These are the cases that we absolutely love. Singles win the game. As an average broker, you get 20 of those a year or 15 of those a year. In 5 years, you have more work than you know what to do with. So you got this the case, a 20 life case with $60,000 in annual premium, a business owner that's active in their business, and all of a sudden, boom, one claim for a drug, is $75,000 or more. Well, what happens to that benefit plan? Well, it's quite simple. And we've seen this time and time again. Kaboom! The benefit plan just blows up. Forget about EP3. Forget about moving the case. That's a bunch of hogwash. And I don't care if you're Great West Life, Manulife, or Sun Life. I can show you, and I can show all of these guys, examples of where this has happened and no one wants the case and the rates just go through the roof. Right? This is without a doubt the biggest risk in any benefit plan today in Ontario or Canada for that matter. It's the opportunity for a small case when they got a $75,000 or $150,000 drug, that's the one drug is more than the entire premium of the entire case. And it just explodes. And again, forget about EP3, forget about moving the case. The client is screwed at that point. Rates go through the roof on all levels. The insurance company doesn't necessarily want the case, so they just rate it by 60, 70, 80% a year. And we've got examples of this in our office that we can show you all day long. Right? It just explodes. Benefits were not made for this. Insurance weren't made for this. So what do we do? Well, when we're talking about risk mitigation, we've got 3 solutions with respect to drug plans. Well, a drug maximum, pre-existing condition clause, and a restricted formulary. So let's talk about the 3 of those things. What can be done with plan design with respect to drug plans? This is the biggest risk. This is where the rubber hits the road. What can we do about this? And it's not what we can do about it. It's what's the client going to choose to do about this when they truly understand where they're going and what the risk associated with their benefit plan is. So again, you've got this great client that's got 20 employees, and they're excited about the future, and they're excited about their employees, and they don't understand the risk, and all of a sudden their plan blows up. Yeah, that's a problem. So we've got to deal with it, and we often have to deal with it in advance, and it's your opportunity and ours to sit down with clients and say, hey, terrific, let's talk about risk mitigation. And in these 3 particular areas with respect to drugs, again, a drug max, pre-existing condition, or a restricted formulary. Well, a drug maximum. It's simple. A drug maximum is easy to understand. It's easy to implement. We just say, hey, terrific, the drug maximum is going to be $5,000 a year. Or the drug maximum is going to be $10,000 a year. Or it's going to be $7,500 a year. It's interesting. We have meetings with brokers and the end user clients, and we talk about risk and we talk about risk mitigation, and they go, shit, I don't even want to deal with this. We're just going to go put in a $5,000 drug max. All right, next. It's that simple. That's what it is that they're doing. And some people take, they just go, we don't want to be in this business. This is not our business. Our business is to polish widgets. Our business is to pay our people a practical and fair wage. And our business is not to insure a $150,000 drug or a $75,000 drug. So when we put in a drug max, it's easy to implement, it's easy to communicate, and it's easy to understand. It's an easy solution to certainly risk mitigation. There's the easy button. Boom, push it. That was easy. Actually, Mike, we have one over there on my desk. We should, yep, hold on a second.
That was easy.
Yeah, there you go. It sounds like that. There we go. So the risk mitigation. Problem with this. Yeah, it's easy. Let's all do it. Well, no, there's problems with it. The problems with it is it may cut someone off some needed medication. The train may, or the horse may have already left the stable, so to speak. It may cut somebody or people off of necessary medication. In addition to that, if there's no one that's taking that medication, it also may be perceived as a fairly significant reduction in benefits. The other side of it is you're making a big change to a benefit plan, and it may not have any immediate cost impact. There may be no reduction. So the client's sitting there going, yeah, great, let's put in a $5,000 benefit. How much is that going to, or $5,000 max? How much is that going to save me? And the answer is nothing. Right. There might be some large amount pooling charges that you're paying, but it's really not going to have a significant cost impact that may be immediate. So all of a sudden they're going, well, hold on a second. I'm going to get a perceived reduction in benefits. It's not going to save me anything. No one's taking these meds. Why do I do this now? So these are the types of questions that you've got to answer. And these are the type of objections that you got to put into place, or that you've got to be able to discuss with someone. So it's simple on one side, but it's not quite as simple on the other side when you look at it. So just be cautious of that. Right? A pre-existing condition clause. And we're talking about in a drug plan, really? Yep. You can put a pre-existing condition clause in a drug plan. And we've been using this, Mike, for how many years? Oh, yeah, well, 10. Well, forever for you. Mike's much younger than me. So forever for him is like 10 years. Forever for me is forever, like, some of the older people that are on the call. Right? But we've been using a pre-existing condition clause in a drug plan for 10 years or maybe even more. But it's interesting because the insurance companies look at us like we've got two heads. Are you guys nuts? And then now they're starting to look at it a little bit differently. But what's a pre-existing condition clause on a drug plan? Again, think from the employer's perspective, not the insurance company's perspective. Think from the employer's perspective. Let's limit drugs on new and future employees to $5,000 for the first 12 months. So, for example, if an insured is taking medication that exceeds $5,000, they're going to be limited to that $5,000 condition while on the plan. If they've got 12 months of no, oh my God, we didn't change that, Mike, not FIST. Should be first. Pardon me, I changed that. I want you to know that I made the correction, but Mike didn't pick up on it. Okay, there we go. The first 12 months, if we make the decision to we lost the sound. Okay, no, I think we're back on. If you limit the drugs on new employees for the first 12 months, right, to just a $5,000 max, then if they're taking a medication, they're going to be stuck with that $5,000 limit for the remainder of the time while they're on the plan. If they're not taking any drugs or any drugs that exceed $5,000, then all of a sudden they develop something a year, 2, 3, 4, 5 years down the road, then they'd be covered. But what this does is it protects the employer. It protects the employer from hiring people that have a problem. So all of a sudden, using that example that we used a few moments ago, where they got a 20 life case, they've got $3,000 per person, they're spending $60,000, and then they go and hire somebody new. So far in January here at the Benefits Trust, we've hired 4 new people. They hire 1 or 2 or 3 new people. Then all of a sudden, during that interview process, you can't ask questions like, hey, it's nice to meet you and we'd like to offer you a job, but before we offer you the job, are you or your husband or any of your children taking any significant medication costs or have any significant prescription drugs, pardon me? Any drugs that, we say, hey, great, this is what our benefit plan is. It's limited to $5,000 in the first year. There's a pre-existing condition clause. And, that's what our benefit plan is. And this is what our RSP is, et cetera, et cetera, et cetera. So the potential employee makes a decision on whether or not they want to work there. We have an example of this where it worked out famously, where all of a sudden a new employee came in. This particular employee had a partner, and the partner had a need for a medication that was along the lines of, I can't remember exactly what it was, but it was about $40,000 or $50,000 a year. 3 months to a day, all of a sudden the new employee becomes part of the benefit program and starts making claims. They're cut off at the partner's cut off at the $5,000 attachment level and starts jumping up and down. I got a call from the general manager of the company because the broker wasn't available, and I got a call from the general manager of the company who I met with, and he forgot about this pre-existing condition clause, and my conversation was quite it was quite interesting, because I'll never forget the conversation. I said, "Hey, Mr. Client, we put this in place in your benefit plan to protect you and your existing employees. Again, it's to protect you and your existing employees against this exact same thing, or this exact component, right? This exact situation. All of a sudden, you've got a new employee who's been there 3 months, is putting in a $40,000 claim for his or her spouse or his or her partner, and then it's going to blow up your plan. And all of a sudden, the client was going, "Oh my gosh, that's right, that's terrific. Now I remember. Thank you very much for putting that in place." So look at your current claims. Look at your client's current claims. If there are no large amount pooling claims, what I suggest is you implement a pre-existing condition clause as fast as you possibly can. Certainly have the discussion about it. It protects against claims from future new employees that can bring high-cost drug claims into your clean plan. So all of a sudden, Mike, who has been an employee here for 12 years now, Mike, that's why you only remember 10 years ago.
I think it's 15 now.
Okay, well, you know what? You're just like the furniture now. But anyways, Mike's been here 15 years, and Mike's very important to our organization. He's very important to the success of our organization. Terrific. All of a sudden, if I bring one of these new employees, and as I mentioned, we've hired 4 employees in 2018 so far. If I bring one of these in and they've got a $50,000 drug or a $100,000 drug, all of a sudden, when it comes time to renewal, I'm sitting there going, "Hey, Mike, sorry, you've been here 15 years, but we're going to have to cut your benefits off, or we're going to have to reduce your benefits because some new employee's spouse or kid has a problem." Anyways, it protects claims from future new employees. Everybody wants this. Make this part of your client's plan. And if the insurance company won't provide you with a pre-X, I know someone that will. Make sure you visit thebenefitstrust.com or come and talk to Mike or myself, and we'd be happy to help you out with this. So we're talked about putting in a drug max. We talked about putting in a pre-existing condition clause and utilize that. Let's talk about a restricted formulary. This is something that's relatively new. So at the Benefits Trust, we're a full-service third-party benefit administration company. We provide budgeted ASO solutions, and our drug card that we use the Claim Secure engine, and they've created this restricted formulary, and it's called Formulary Protect and Formulary Protect Plus. So we've adopted these programs, and it's fascinating the conversations you have with clients. What is the Formulary Protect? Well, it's quite simple. It covers you for drugs, and it utilizes the Trillium Drug Program that was established in 1990. So for those of you that don't know, the Trillium Drug Program was established by Bob Ray in 1990, and it was primarily, and all other provinces adopted a very similar type program. Obviously, ours is called the Trillium Drug Program because of the provincial flower. But the Trillium Drug Program was started in 1990, and that's 28 years ago this year. And it was started by Bob Ray because primarily at the time there were a lot of men dying of AIDS, and the medication that they had at the time for the AIDS disease was extraordinarily expensive in relation to all other medications. It was the first expensive medication. So gentlemen were dying of AIDS, and they were dying on the front page of the newspapers, and they were saying they can't afford the medication that's required. So the Trillium Drug Program, along with other provinces, started those drug programs all around the same time. And it was allowing people that says, quite simply, if you have a requirement for an expensive medication, after you satisfy a means test of 4% of household income, the benefit plan or the drug program will kick in and pay for those expensive drugs. So people can take those drugs and for medically necessary, obviously, reasons. So what this particular Formulary Protect program does is it takes advantage of the drug program that exists here in the province of Ontario. So what it says if a specialty drug is going to exceed $10,000. How do they being claim secure, how does anybody define what a specialty drug is? Well, I take a specialty drug for cholesterol management. Yes, because that's all it does. It's special. It's cholesterol management. Claim secure defines in this Formulary Protect is a specialty drug formulary that says any drug that exceeds $10,000 on an annual basis, we're going to define as a specialty drug. And any time that somebody has a requirement for a drug that's going to exceed $10,000 in a benefit year, the member first has to use the Trillium drug program, and that'll be covered from first dollar. So the drug will be denied, and they will be instructed, the member or the member's family will be instructed to use the Trillium drug program for that particular drug. So it says, hey, great, we're going to cover you for all those things like Lipitor. We're going to cover you those things like birth control pills, and we're going to cover you for your blood pressure medication and your diabetes medication and what have you. And if your kids need amoxicillin for your ears, all those regular types of stuff, no problem. But all of a sudden, if you need a drug that's going to be $10,000 or more, you're going to be directed directly into the Trillium drug program. So it's a pretty powerful thing. You're saying to your employees, those 20 employees that we're using as an example, we're saying, hey, great, we're going to cover you for all your routine drugs, but if you have a drug that exceeds $10,000, we're going to steer you into the Trillium drug program, and we've got smiley, happy people that will help you with that application process. Terrific. Well, this is significant. There's a significant price reduction here because of the risk mitigation policy that's put into place, or specifically the restricted formulary. This reduces the stop loss premium or large amount pooling premium by 50%. This is significant, right? There's a 50% reduction in stop loss premium when you implement this restricted formulary. So pretty powerful stuff. So it's interesting. We have this as part of our routine. What's it called, Mike? Our routine renewal process. We have a couple pages where we introduce this particular formulary, and we want all employers to either be aware, which is certainly to be aware of it, and to make a choice whether to purchase it or not. The second restricted formulary we have is sort of a step in between. It's called the Formulary Protect Plus program. The Formulary Protect Plus program works in a very similar way. We want to take advantage of the drug programs that are available through the province of Ontario. We all pay taxes in the province of Ontario. Some of us pay certainly more than others, but we all pay taxes. We want to take advantage of the programs that are available, just like in the Formulary Protect program. If a specialty drug is going to exceed $10,000 a year, the member has to use the Trillium drug program first. Well, hold on a second. There are drugs that are going to exceed $10,000 a year that aren't included in the Trillium drug program. They're not part of the 4,400 drugs that are on the Trillium drug program formulary. So if the drug's not available under the Trillium drug program, or if the drug's not available under the special access program, then the drug comes back after everything has been exhausted. Then it comes back to the existing benefit plan. So if the drug's going to exceed $10,000, we throw it over to the Trillium drug program. Then we throw it over to the special access program. Then
Exceptional. Exceptional access program. I got to change that.
Sorry, I always thought it was special access. The exceptional access program, where we apply to the province of Ontario and say, hey, cover this drug for the medically necessary ailment that the particular individual has. Terrific. If it's still not available, if the government says no, if Kathleen Wynne says no, then great. Then we make it payable under the benefit plan. Oh, we missed something here. But there's a price reduction in that, right? So if it's still not available, then what happens is the provincial program, once the provincial programs are exhausted, then the claims comes back to the employer-sponsored benefit plan. So they have coverage, but we just exhaust all of the Ontario programs that are available. This reduces the stop loss or large amount pooling premium by 22%. So again, risk mitigation, it reduces the premium by 22%. So you want to eliminate stop loss or large amount pooling, put in a limit on your drugs. Put in an upper limit, $5,000 here, or $2,500, or $10,000, whatever makes sense from the client's perspective. You want to put in a restricted formulary? Terrific. You can put in a restricted formulary, mitigate your risk, reduce the premium in your large amount pooling or stop loss by either 50% or 22%. It's powerful stuff. So how do we incorporate this type of thing into plan design? Well, that comes back to that question. What are the groups within the group? Not everybody has to have it. You can have some groups within the group that have a drug cap, a hard cap, $2,500, $1,000, $5,000. You can have some where you say, "Hey, great, we're gonna put in a drug cap." Other groups we're gonna have a pre-existing condition clause. We got a lot of turnover in this particular group. We're gonna have a pre-existing condition clause and utilize that. We're going to have this particular group over here, the yellow group that has Formulary Protect, the green group that has Formulary Protect Plus, and the blue group, the executive group, where they're just going to have an unlimited executive plan with the appropriate insurance policies in place. So you can have a 10-person group or a 15-person group and have different benefit plan designs for each of those groups within the group. It's as simple as that. So here's an just as we mentioned here, the slide's a little redundant, but executive plan's got no restrictions. A management plan has the Formulary Protect Plus plan. There may only be one member in that particular group. The employees with more than 10 years of service have Formulary Protect, and new employees have a $2,000 drug max, and there's a pre-existing condition clause put in place on all classes. This can be a 10-person group. You can have risk mitigation for the different groups within the group. It's as simple as that. These are the kind of conversations you need to have with your employer. It's not one size fits all. So we talked about drugs, risk mitigation with drugs. Now let's talk about paramedical services and dental plans for that matter, and a combined maximum in this particular area. Sorry, just taking a glass of water there, folks. So a traditional paramedical plan, again, a smaller employer, they might have a traditional paramedical plan design. It might be $300 or $500 per practitioner. There's approximately 10 listed practitioners. You can have anywhere from $3,000 to $5,000 of exposure, and a family of 5 can have up to $25,000 in claims. Does it happen? Rarely. Do we see it happen? We have. Certainly seen it happen. So all of a sudden you're sitting there going, hey, we're talking about risk mitigation. Mr. Client, Mrs. Client, you're exposing yourself to a great deal here. In the last 12 months, in 2017 over 2016, paramedical expenses were up an extraordinary amount. I don't know the exact percentage, but we had plans. I know 2 in particular, where we had plans where paramedical claims were up over 100% over the previous year. And there was no fraud that we could find on either of those 2 plans. But paramedical claims were up 100% over the previous year. So traditional paramedical plan, there's some pretty significant exposure. This isn't necessarily a kaboom like our drug plan example that we used, but this is a pretty big and significant expense. All of a sudden, you've got 10 listed practitioners, and you can have, in your family of 5, you could have up to $25,000 in claims. Well, how does this happen? How does this happen? Well, you've got, first of all, a change in all sorts of different types of paramedical services, and a change in mindset with healthcare professionals when it comes to paramedical services. Healthcare professionals, you walk into a doctor and say you've got a sore elbow. Historically, they're going to examine you, and then they'll say, okay, terrific, and what we're going to do is this, this, and this, and then come back and see me if it still hurts. Now they say, hey, terrific, have you seen a physiotherapist before? What has the physiotherapist said? They're relying on these particular individuals. And what's happening is you're getting these multidisciplinary clinics. And these multidisciplinary clinics, provide massage, chiro, physio, acupuncture, a number of different things within the 4 walls of their clinic. So an example of this is I was skiing at Mont Tremblant a number of years ago. I was skiing at Mont Tremblant, and I fell and dislocated my shoulder and had to get my shoulder popped back into place. and it was really quite badly dislocated, and it was sore as heck. I've never experienced pain like that before. And I got back to Toronto, or got back to Newmarket, where I live, and went into the first time I went into a physiotherapist's office. I said, I got this problem. I can't move my arm. My arm was dislocated. My shoulder was dislocated 2 days ago, and I need some help. And the physiotherapist came out and said, terrific. We'll set up an appointment for you. But the second thing he said is, he goes, do you have a benefit plan? And I said, well, you're asking the wrong guy, but let's play along. Yeah, I've got a benefit plan. He goes, good, because you're going to need a lot of physiotherapy, right? Because you got to get your pitching arm back so you can start for, opening day for the Blue Jays. And we got to get that back into shape, and you're going to need a fair amount of physiotherapy. And I said, okay, well, what does a benefit plan have to do with it? He said, well, because physiotherapy is covered under your benefit plan. And he goes, do you have any idea what your benefits are? And I go, no, it's a pretty traditional type plan. Again, you're asking the wrong guy, but let's play along. And I go, it's a pretty traditional plan. I think it covers $500 per practitioner. And he goes, terrific. Because in our office here, we have, just as I mentioned on the previous slide here, we've got this multidisciplinary clinic that has massage, chiro, and physiotherapy, maybe a couple of other things. And he said, terrific, we are going to call it physiotherapy until your benefit runs out. Then we're going to call it chiropractic until your benefit runs out. Then we're going to call it, something else till your benefit runs out. And I'm going, oh, okay. And then he goes, are you married? And I said, yep. And he goes, terrific. Then we're going to put it under your wife's plan. Good news is you won't have to pay a thing. He was saying, hey, we'll help you get this covered. Don't worry about it. The insurance company will pay. I said, well, terrific. I'm not going to deal with you because, first of all, that's illegal. Second of all, it's stealing. And the third thing is, you're worried about how you're getting paid. You're not worrying about my care. So I went to another clinic and got the appropriate care that was in place, and someone that wasn't doing it on an illegal basis. But it's interesting, we'll help you get this covered. Don't worry, the insurance company will pay. There's often a disconnect between your employees or your client's employees and their understanding of who's actually paying for these benefits. Yeah, the insurance company might be facilitating the transaction, but they're not paying for it. The employer's paying for it, right? And often what happens is the average employee has, really kind of no idea that this is wrong. Oh, okay, the insurance company will pay. I don't know. I'm listening to the practitioner. Terrific. No big deal. Right? Abuse is often in the hands of the practitioner. That's a trusted advisor. Hey, who am I to tell this guy he's doing something wrong? He's been to chiropractic school for half his life, right? And they're just going, hey, I just want this thing paid. I don't want to have to think about it. So as a result of that, we're saying, hey, put in some plan design examples where we're saying, instead of having, a $300 to $500 practitioner, with 10 practitioners listed, we're saying, hey, great, have a $300 to $500 per practitioner, but a combined maximum of, for example, $900 for every single employee and $1,500 for every family. So you can only spend $300 at the massage therapist, but you can't, the whole family can only spend $1,500 in paramedical practitioners as a family unit. Or have no employee maximum, so they have that $300 and $500. $300 or $500, whatever I'm just using that as an example, but have no family maximum, but have no employee maximum, but have a combined family maximum. So the abuse opportunities are somewhat limited. Or some people are just going, I don't really care. We're just going to have a maximum employee and family maximum of, for example, $2,000. But again, this is about risk mitigation. We're not necessarily cutting people off, but it's just about risk mitigation. And those are some examples. Oh, one of the things, before we go to dental maxims, one of the things that I want to talk about here just for a quick second, and I meant to put this in and I didn't, I apologize. Just a little sidebar. What a lot of employers are doing when we're having these conversations is they're saying, okay, great, let's do this family maximum, or let's do this overall maximum. Let's put this $300 per practitioner in, or 70%. Per visit up to a maximum of X or Y, whatever a maximum they want to put in. But one of the things that employers are doing is they're saying, okay, forget about that. Let's do all of that. But the exception of mental health, they're saying, hey, terrific. Let's put in $1,000 per person instead of $500 per practitioner. Let's double it. And let's put in $1,000 for mental health practitioners. So therapies and psychologists and so on. They're saying, let's put that in a separate class or separate benefit line. Let's not lump it in with the other paramedical practitioners. Let's keep it separate. Let's put in $1,000 max or double it or triple it, a $1,500 max per person. And let's make it real. And why employers are doing that is they're saying, hey, great, we also are encouraged, or not encouraged, we are also cognizant of the mental health issues that a lot of people are having today, and we're taking a very proactive role. So they're saying, hey, let's mitigate our risk over here, but we believe in you and want to help you if you have a mental health issue by increasing the limit over there. So just a little bit of a sidebar. Have the conversation with your clients. It's an important component of their benefit program.
And of course, this is also a good opportunity to use healthcare spending accounts creatively as well.
Absolutely, Mike. Dental maximums, same rules apply for dental maximums for the same reasons. Dental businesses are becoming more competitive. Last Friday, I was hanging out with two dentists at our ski club. It was Men's Day at our ski club, and I was hanging out with these two guys, and both of these guys are dentists. One up in Huntsville and one in downtown Toronto. And we were chatting about the competitiveness of the business. And both of these guys are the same age as me, mid-50s, and they were sort of talking about how the business environment has changed. The dental business environment has changed, and it's still becoming more and more competitive. And it's interesting whether your community is a large community or small community, the dental business is incredibly competitive. And people are doing all sorts of different things to continue to be competitive in this field. So, we want to put in those family maximums. We want to put in those maximums and those combined maximums because our dentists practicing ballpoint dentistry? And the answer is some are. There was a study a number of years ago on W5, and there was a study done, and they were saying, potentially up to 80%. I don't know how true this is, but potentially up to 80% of the dentists are practicing ballpoint dentistry of some sort. You're sitting in the chair, and again, there's that disconnect. There's that disconnect between who's paying for the service. The consumer isn't necessarily paying for the service. So there's often a disconnect. And because of the dental organizations, saying, hey, terrific. What we need to do here is we need to work so we can have direct payment from the insurance companies to speed up our services. Hey, it's crazy what's going on there. And they're saying, hey, as long as I don't have to pay, as I like to say, borrow, wife to pay for husband's claims. Hey, as long as I don't have to pay, I don't really care. Again, do they think they're doing anything wrong? So it's important to utilize employee and family maximums on dental plans and include this in the risk management conversation that you're having with your clients, or risk mitigation conversation you're having with your clients. So we got a few minutes to go here, and let's talk about the third component, life insurance and AD&D. And let's talk about risk mitigation with life insurance and AD&D. And I got a question mark there. What? What are you talking about? Seriously, dude? Dude, seriously? We're talking about risk mitigation and we're talking about life insurance and AD&D? This is something I've been talking about for some time now, but when you think about it, there's an opportunity here to, again, include this in the conversation with your clients, right? Risk mitigation, it's about their risk mitigation, but it's also about your risk mitigation. It's about the employer's risk mitigation and your risk mitigation as the advisor. So for example, if you have a flat life benefit, flat life and AD&D benefit versus a function of earnings, and when you have it as a function of earnings, increases often go unnoticed when they're tied to salary. We just did a salary change here at the Benefits Trust a week or two ago for all of our employees. And if it was a benefit that was 1 or 2 times their earnings, they would have that probably would have gone unnoticed to the majority of them. Or great, I just got a $1,000 a year increase in my life insurance. Big whip to do. It goes unnoticed or it goes unvalued, right? When it's tied to salary. So a flat life insurance and AD&D amount, I think, is easier to understand. It's easier to manage. We're saying, hey, executive employees are getting $100,000, management employees are getting $50,000, employees are getting $25,000, for example. But they're easy to understand. They're easy to manage, and it reduces your risk and your employer's risk a fair amount and also creates opportunity. So let me explain. You never run into an NEM problem. So for example, we just raised our salaries here at the Benefits Trust a month ago or a couple of weeks ago, and all of a sudden, if somebody was right on that cusp, and they think they've got $52,000 of the life insurance, and they only have 50 because our NEM is at 50, and they die, they think they're getting $52,000, or their named beneficiary is thinking they're getting $2,000. But are they going to go through the process of filling out an evidence of insurability form for $2,000 worth of insurance? They're probably not going to do it, right? But it's never running into an NEM problem. It's never miss an increase in benefit. The employer never has to, if the employer decides to change the benefit, they can. But they never have to fill out an evidence of insurability form. And sometimes these things never get filled out. They give them to them, but they never get them back, so they never have to miss a follow-up. And what is reasonable? Geez, I asked you for this 6 months ago and I didn't get it back. Oh yeah, I forgot about it. It's in the bottom of my briefcase, or I lost it. Can I get another one? Or I have to go to the doctor. I'm just going to wait till after that. So you never run into these problems. The other thing is, if you're declined, because when you look at an evidence of insurability form for a group life and health, or group life and AD&D plan, if there's about 5 or 8 questions, depending on the insurance carrier, there's 5 or 8 or 10 questions. If you've got one of those 10 questions and you answer the question incorrectly because you've had high blood pressure, or you've got high cholesterol, or you say no when you should have said yes, or yes when you should have said no, you're declined. But now the employee has to answer yes every time they complete an application for insurance that, have you ever been rated or declined for insurance? And the answer is going to be yes. So they've got to answer that question, declined. And you don't want to be put in the position, in my opinion, or at least I don't think you want to be put in the position, in my opinion, where you've got that, risk of having to tell someone they're declined because it's a short form medical application and it's just becoming more and more confusing. So the risk mitigation is theirs and yours. When you have a flat life and AD&D benefit, it's interesting because what it does is it makes it really easy to communicate. It makes it really easy to understand. It makes it really easy to establish future life insurance sales opportunities for you. When you tell an executive they got $100,000, or the executive goes, I don't know how much I have. Do I have 1 times my earnings or 3 times my earnings up to an NEM of what? No, you've got $100,000, Mr. Executive. You've got $100,000, Miss Executive, right? Is that enough to cover your family needs? We should meet and discuss this, to understand what your family's requirements are. It's just a nice round number. It's easy to communicate. It's easy to understand, and it's easy to establish future life insurance sales opportunities for you in the future. You can take that commission that you're earning from the group insurance and you can parlay that into 10 times what you're earning on the group insurance by selling appropriate insurance. And when you've got that flat amount of life insurance, it's easy for clients to understand that. So a benefit plan, in summary, a benefit plan is a promise. What do you want to promise, and what do you want to promise to who? What are the groups within your group? What do you want to promise? Let's have a risk mitigation discussion. Regardless of the risk mitigation discussion, again, this can be done by class regardless of the size of the plan. So we've got 10-person plans that have 4 different classes of benefits with 4 different risk mitigation opportunities in each of those different classes. It depends on what the client wants to offer. We're saying have these conversations. You want to add value, especially with G19 coming down the pipe in the near future. You want to add value. Have these conversations. Have them as a separate meeting. Don't have them as part, in my opinion, don't have them as part of your meeting where you do the renewal. Have them, have this meeting halfway through the year. Have it at the beginning of the year, whatever makes sense. But have a risk mitigation discussion with a client. Let's be clear, the house wins 80% of the time. This is a slide that I've been using for years. The house wins 80% of the time. You go to Vegas, yeah, they got big hotels. You know why? Because they win. They're profitable. The house wins 80% of your time. Help your clients understand the risk. Help your clients understand where the risk is and help them mitigate that risk. And they can be the house. You do this by asking, in my opinion, great future-based questions. You got to understand where the client is going in the future, not where they've been. You got to understand where they're going, and it just frames the conversation to have excellent future-based questions. It frames the conversation beautifully to have that risk mitigation discussion. So ask those great future-based questions. Hey, if we were standing here 3 years from today, the 13th of February, 2021, 2021, what do we have, what has to have happened for you to say this has been the best 3 years of your life? A great future-based question. Ask those questions. So again, the purpose today is really to help others succeed. We hope you picked up an idea. We got just a few moments left. We hope you picked up an idea or two on how to deal with your clients and future prospects and so on. And we want to talk about risk mitigation. We're open for business. Please feel free to call Mike, myself, or Carrie Lane in our office. Visit thebenefitstrust.com. We're happy to work with you. We work with brokers like yourself. We provide a budgeted ASO solution. Client sends us money. We take that money and we send it out to insurance companies to have the appropriate insurance in place. We pay and adjudicate claims based on the claim promise that the employer is making to the employee. We provide an appropriate administration solution, and we charge an appropriate amount for that. And then we send you and we send the end user client a financial statement on a monthly basis that says, this is what you paid us, this is what we paid out, here's what your balance is. No surprises, great communication. That financial statement comes on a monthly basis. Looks like this: month actual, first column current, month actual, year-to-date cumulative, and after 12 months previous year-to-date cumulative. So the client sees exactly what their surplus or what their deficit is on an ongoing basis, so they know exactly where they are and exactly where they stand. At the Benefits Trust, we've got an extraordinary quick claims turnaround time. We've got a claim paying app that we've been using for many years now, Pay Direct drug cards, EDI dental, email, fax, online claim submission, all the wonderful things that clients are used to. We're not falling behind on this. We're leaders on this stuff. As well as that, one thing that makes us very unique is we answer the phone. We got full service administration solution within the four walls of our office. We provide that monthly financial statement to you. We take a conservative budgeting approach, and we've got industry benchmark setting levels. One of the things that's interesting is my son is 24 years old. He now works in our office. He's a claims administrator, and he goes, he says to me on the way home, he goes, Dad, I can't believe how many people are happy that we answer the phone. He goes, it just blows me away. Oh my gosh, a live person. This is great. Can you help me? And the answer is yes. They ask some security checking questions, and then they answer their question right away. So within 30 seconds or 45 seconds, they've got their answer, and they're going, wow, I can't believe this. A live person answered the phone, and I've got a satisfactory answer. They may not like the answer, but I've got a satisfactory answer to my question within 45 seconds. It's awesome. So key elements of ASO when you're talking to clients and talking about risk mitigation and talking about ASO, just a couple of high-level points that are important about ASO is, number one, the appropriate insurance to protect the promise. The promise, insurance is there to protect the promise, the integrity of the promise, so it continues into perpetuity. The pre-existing condition clause that we were talking about in your drug plan is there to protect the promise, so it continues into perpetuity. It's there to protect the employer. Insurance is there to protect the employer. Let's make sure we got the appropriate insurance in place. Responsibility of budget. It's having the appropriate budget so the claims are covered. And the third component is administration fee that's appropriate. This isn't a race to the bottom. This is not a race to the bottom. Hey, we can find someone who will do this for 3%. Terrific. Knock yourself out. It's probably not going to work in the long run. We've just had a client come back to us the 1st of January, come back to us after a year hiatus. They joined another company because somebody came in and with a lesser administration fee. And they changed as a result of it. And they came back with their tail between their legs saying, yeah, that was a bit of a mistake. We apologize. Can we come back? And they came back to us because we provide great service. And we communicate effectively, we communicate on an ongoing basis, and we communicate both to you, the broker, and the end user client, so there aren't any surprises. The result is, without a doubt, a happier client. So if you want happy clients, great, look at an ASO solution. And look at an ASO solution with the Benefits Trust. There's our commercial. Risk mitigation and plan design. We talked about drug plans. We talked about three things with respect to the drug plans. We talked about putting in a drug max. We talked about restricted formulary, and we talked about pre-existing conditions, not necessarily in that order. We talked about combined family maximums, combined and family maximums with respect to paramedical and dental services. And we also talked about a risk mitigation solution, both theirs and yours, with respect to life and accidental death and dismemberment insurance. Have a risk mitigation meeting with your clients. Your client's business looks like the cockpit of this airplane. They're flying at 35,000 feet and 800 miles an hour. They don't have time to think about benefits. But when they do, have a risk mitigation discussion with your clients so they can have it on their radar and it makes sense to them. People that are in business do business with people that are in business. Be in business and have a risk mitigation discussion with your clients with an agenda. Have it so they understand it. Break it down into those three different areas and have those discussions. Again, great question. What are the groups within your group? talk about reduce, transfer, accept, and avoid risk. That's a terrific slide. It's about reducing risk, transferring risk, accepting risk, or avoiding risk altogether in the benefit promise that the employer is making to the employee. Be the leader, lead the conversation, be the trusted advisor, add value to your relationships. So when G19 comes into play, you're not standing there with your pants down around your knees. You're ready to go, and you're ready to stand up and say, yeah, this is why I get paid, and the clients are good with it. Thank you very much for your time. We greatly appreciate it. We spent an hour together. Mike's going to send you a very short email that says, here's your CE certificate. We're also going to send you a very short survey. Fill it out. Check our website, thebenefitstrust.com. We've got a number of other issues that we're going to be discussing with respect to webinars in the upcoming future. So we thank you very much for your time and wish you great selling. All the best. Bye for now.